Hi there, thanks for stopping by. Today I have Tim McCarroll as our guest. He's going to talk to us about how to repair our credit. So I have often have clients that stop by and want to get into a home and unfortunately need a little bit of help. So Tim's going to give us some ideas and tips and tricks about how to do that.
Some ideas, yeah, for sure, of course. Let's get into it right away. What's the first question?
All right, so how do buyers go about improving their credit? I know it's multi-step, so let's do an overview.
And it can take some time too, so please be patient about this, okay? Basically, there's going to be some tidbits you can definitely include in your lifestyle to get yourself to a better and higher credit score. Obviously, one of the biggest questions I have, I'm going to kind of start with this one first, is what is a good credit score? Where does a credit score need to be in order to be considered to be good? It really depends, unfortunately. There's not one straight answer. Normally, a default mortgage insurer like CMHC wants to see a minimum credit score of 680. However, obviously at 680, you may not still have a good enough credit score because you may have had some deficiencies, some collections, or whatever the case is. So again, it's not always a one fit, answer. My personal opinion is 700 is good. Usually it's really good, obviously, based upon decent credit score and history. I've seen people get mortgages with even a 620 credit score. But again, it really just depends upon where you're at. If you're just establishing your credit, 620 could be enough for sure as well. But regarding the secrets, the tidbits that the main question was about, there are some really good insight information that I have on my Instagram page. It's at Mortgages by Tim, and I've definitely done a little bit of a docket series regarding getting your credit score up. I'll talk a little bit about that, but I'm also going to give you some other insider information as well. The biggest thing that I can kind of relate to is making your payments on time when it comes to your statements. So I do not recommend making payments to your credit card, let's say, every week. And I know I would love to be doing that myself. I went out, spent the money, got the points on the credit card, made the payment, I'm good. It's not exactly helping because you're not allowing the actual institution to actually report anything to the credit bureau on how well you've been doing when it comes to making payments and so on and so forth. So definitely wait for the statement. I would recommend making the full payment of the statement, not just the minimum. Minimum would be the minimum, the guaranteed one I would recommend. But again, making as much as you can so you can avoid all the interest that you incurred for that particular month. So example, right now, let's say you get your statement and it's for the month of October, or September, let's say, that'll be better. And you have your statement and you spend $500. I recommend paying off that $500. Okay, but again, you may have spent more since that statement's come out. Still concentrate on what that actual statement balance is. That's going to be really important for sure.
And so we've touched about on how much to pay.
Yeah.
So ideally, it's pay the full amount if possible. Bare minimum is the minimum.
You got it.
And what debt ratio are we looking at that is a great or an acceptable rate for a first-time home buyer?
A debt ratio? Okay, so there's something called a stress test. A stress test does elaborate that there's two different types of measurements being used. One's called total debt and one's called gross debt. Now, both of them are kind of similar, whereas the gross debt is used for both measurements, but when it comes to total debt, it also encompasses more. Example, car payments, so on and so forth. So for a gross debt, which is just your gross income, minus the expenses for the home, whether that's property tax, condo fees, and the mortgage payment, you can go up to 39%. Okay? For total debt, which includes your house, your car payments, as well as, let's say, credit card payments, a student loan, whatever the case is, that can go up to 44%. And that actually is where the kind of the ballpark is. If you're putting more than 20% down as a down payment on a house, you can go past that 44%, but it's not normal. It's it kind of almost like a one-off. It happens every so often. Yeah.
Okay. Great. So I do come across some clients that have done a consumer proposal, and I know that you and I have talked, frequently about whether it's a consumer proposal or a bankruptcy. So I think a lot of people that have done a consumer proposal or declared a bankruptcy think that they can't ever get into a house. So is that true?
No, it's not actually. So when I actually got into the industry, one of my clients actually was a kind of a dear friend of mine. It was one of my kids' friend's mom, and obviously she went through a really bad breakup. the ex-husband used her name without her knowingly knowing, and he racked up major debt for the company and for personal as well. They got divorced, and she was in a really big jam, and she actually did do consumer proposal in this particular example. So to answer your question, consumer proposal and bankruptcy. So we'll talk about consumer proposal first. You do need to make sure that you are completely finished with the actual proposal. It is completely basically dismissed. All right. Then you have to also wait about 2 years of basically rehabilitating your credit. So I always recommend to my clients, get a credit card right away, like right away. And then if you can, try to get a car loan right away. Yes, I know you may have all the cash in the world, but you're trying to reestablish credit, which is really important to have different types of credit as well, okay? And that's going to help you. Now, you have to make sure you rehabilitate your credit and showcase that. One thing you have to understand is if by any chance you have a certain bank, let's say a green bank or a blue bank or a red bank, you may not be able to go to those banks and ask for more additional credit because you've unfortunately already severed ties with them, you've left a bad taste in their mouth. It's not always a possibility, just letting you know. Definitely for bankruptcy, 100% not a possibility. So you have to make sure you be very careful on who you affect because it may come back and bite you as well.
So that kind of leads me to I'm very much pro mortgage broker versus a big bank because I think that we have way more opportunities to explore.
Do we ever?
So is there a way for someone to have a conversation with you about, what's their next steps? Are you willing to work with the client to get them through through that journey of repairing their credit?
Yes, good question. So I do actually do a couple seminars as well as just conversations with a lot of clients on where they are today, where they need to get to. It really depends on where they are, obviously, and that's a big step, obviously, because again, it takes the time to educate the people, obviously, that I speak to in regards to what they need to accomplish to maybe make it a little quicker, but at least get there as well. That's a big one as well. When it comes to educating, again, it's unfortunately not one size fits all as well, but there's one that kind of similar, very similar with a lot of people is you definitely want to reestablish your credit as early as possible. Even if that means getting a credit card through maybe not even a bank, maybe through a private lender or whatever the case is, or a cash advance company, okay? I don't always recommend it, but you're trying to at least take baby steps. And once you've established that, and now you can apply to let's say a store credit card, then obviously replace it, remove the other one and put a new one on, and kind of upgrade. But as you're doing this, you're building credit.
So earlier you touched on different types of credit.
Yeah.
So can you kind of go over what that means? Because I think some people think that means like 3 different credit cards.
Yeah, sure. Okay, so when it comes to different types of credit, obviously there is lines of credit. There are student loans. Now the funny thing about student loans that people don't realize actually with student loans is it doesn't help you when it comes to paying off a student loan when it comes to your credit score rising. Some people come to me and say, well, I have a student loan I've been paying off for the past 4 years. It actually doesn't help you. However, if you don't pay off your student loan, it will actually impact you and negatively. And so it's kind of almost like darn, that sucks. But again, it's because obviously just the way it's set up, all right? The other thing is also when it comes to cell phones and internet companies and just phone companies in general, people don't really actually realize that it could be good, but also could be really bad if you kind of, oops, I didn't think about that one. It's kind of not on my top of my radar. That's really important. So that's another big one. Car loans are another big one as well. Whether you're going through the actual dealership privately through them and their own financing conditions, or whether you're going through a bank that they've obviously signed up with, whatever the case is, it's the same as well. Mortgages are very important too because it's a true reflection of what kind of product you are already going to be looking to purchase next or go into as well. And just regular lines of credit. Now, the difference as well, obviously what you're speaking about, is that lines of credit, even though you may have a zero balance for it, a lot of applications, if not all of them, have to use the total balance of the line of credit as if you're going to be using it. So again, it could be bad because the fact that if you have a line of credit where you have $10,000, but you're going to use it, you just kind of use it as a safety net, it could impact you obviously because even though you have a zero balance on it, we have to use $10,000 at 3% repayment as a monthly payment, obviously, and people don't realize that. So having a line of credit is good, but I'll give you my particular example. I may have a line of credit for, $40,000, but I have nothing on it. It's still not as good. So you have to be very, very careful as well. Another thing I was going to mention to you, a really cool tidbit, and this is really important, is it's best if you want to increase your credit score, try to keep your credit spending, not your limit, but your credit spending under 30% of your limit. All right, so what does that mean? So let's say you have a credit card of $10,000, that's your limit. Try to keep your spending under $3,000. Okay, a lot of people come up to me and says, well, I got an opportunity for my credit card company to increase my actual credit limit to $20,000. Fantastic, actually take it. Two reasons why is because it's not like a line of credit. If you don't use it and you keep a zero balance, we still use that measurement. No, not with credit cards. Okay, with credit cards, we use actually what you actually have as a balance. So sometimes I tell my clients, I say, hey, look, you have a large balance on your credit card. You just told me over the phone. Before I pull your credit score, make that payment. Okay, but one second, we're going to get back to that little piece there, because making a payment, it's going to take some time to show up on my credit score. So, but we'll talk about that in 2 seconds. But also keep in mind the fact that if by any chance you had a $10,000 limit and now you have $20,000 limit, you can still spend out to $6,000 and you'll be increasing your credit score in a good positive manner as well. Now, going back to what I just talked about, the fact that payments, the credit report that I get today may not be the credit report that you think you have obviously before. It takes sometimes 2, possibly 3 months for the information to be actually uploaded to the 2 credit companies, which is Equifax and TransUnion. So it's really important.
So that is another little bump in the road I sometimes get is I have a client who, opens their phone and goes, oh, my credit score is this.
Yes, this is important.
And then when the broker pulls it, it tends to be different. So want to chat about
this is an odd one, okay? Because obviously TransUnion and Equifax, they do report different credit scores, which shouldn't be the case, but they just do because they have different lines. So it's called each line on your credit score, your credit report, and I do recommend you definitely getting a credit report. Pay the money through Equifax or TransUnion, only those 2 companies, by the way, okay? But because you get to see if there's any kind of skeletons in the closet, anything that you didn't realize. That's actually what happened to me. I didn't realize I actually had an outstanding balance from a college payment that I didn't know. It was like $300. But I didn't know about it because I had to switch addresses so many times. I'm out of school, right? My parents had actually switched addresses and it never came up. So when I saw it on my credit report, I called the company. And thankfully, in my particular case, they were actually able to remove it because of the oversight. And I obviously was definitely not a problem. So it was kind of nice. And that sometimes happens, sometimes doesn't. Okay? But yes, going back to what you're saying, obviously, if you pull up your credit score on your cell phone and it says that your example at 700, and then you come to me and I say, oh, you're actually at 680, the reason being is because your cell phone only shows a 12-month picture, sometimes less. So a 12-month picture, whereas mine actually shows 7 years. And 7 years is a lot longer, a lot more skeletons in the closet, where you can actually fluctuate your payments.
Right.
So,
fair.
Yeah.
So when a buyer is looking, we all know that there's Facebook ads and Google ads about, buying a house and so many offers. Get pre-approved, get pre-approved.
Yeah.
So every time you click on those pre-approvals, it does have an impact on or it can.
It can.
So the value of working with a broker is you kind of coach me on when to do it, and then when the good timing is for us to start that inquiries again.
So true. So 2 things I'll mention to you, okay? So let's say you're going out and buying a car, okay? You go to many different dealerships, different types of makes and models and so on and so forth, and each dealership is making an application, they're doing a credit check on you. It will not impact your credit after the first one. The first one, it is a hard check, okay? Just let you guys all know, every year you actually get 1 free hard check that doesn't impact your credit score, okay? But what happens, a lot of people ask me, say, well, if I'm going to all these places or I'm getting a mortgage from all these different companies who are looking at me, will that not just drag my credit score down? The actual answer is no. The first one is impactful. If not, it's free. Obviously, that one I told you about. But the second one, third one, fourth one, fifth one, as long as it's done within a 45-day span, it actually doesn't affect your first credit. It doesn't affect your credit because the credit company knows that you're looking for a car or you're looking for a mortgage. They understand. It really depends on how the company that you're going to be looking at definitely declares the credit check. So example, I've had some companies who they don't tell the credit credit score company, you want to call it, the fact that they're actually looking to do a mortgage, they just say personal credit. Well, personal credit could be a line of credit, could be a credit card, it could be a mortgage. They don't know. So it could impact, because doing credit check for a mortgage and doing credit check for a car, those are two different credit checks. So those are different, and they will both impact. But it's not heavy. People think like, oh my gosh, it's gonna be heavy. You can gain back those points within the next month. People don't realize that, and it's worth it, obviously. So yes, going back to what you said, I 100% coach my clients because I ask those in-depth questions, find out when their actual what their credit score is on their cell phone, and kind of gauge it that way. And I don't pull the credit score until I'm at a good point in time. Maybe it might be waiting for a month because you still haven't found a house yet. I know you have a good credit score, but I also want you to kind of take care of this and clean this up a little bit before I before I pull it. Because if I pull it and you have a balance on your credit card from the vacation back in December that you took and you just hadn't paid it off fully yet, I don't know, maybe because you're just waiting on whatever case is, that's fine. But I might recommend pay it off as much as possible, because that monthly debt will impact your GDS and TDS. It's crazy.
Great idea. So again, I brought you this YouTube channel so that we could be resourceful and help buyers. I think what the best thing about my brand and my team and my partnerships is that I work with Tim, and he is able to walk us through the journey of buying a home and give us advice along the way. So thank you, Tim, for showing up.
Thank you.
And you can give us your contact information.
Yeah, obviously she'll add it in the video below, but you can definitely find me at www.simplemortgagescanada.ca, and that'll give you all my information, including booking appointment, even starting an application, even the social media links, as I talked about earlier. Thank you very much. I really appreciate having me.
No problem. Don't hesitate to call. Have a great day.
Take care.